the NAREIT Equity REIT Index I thought would be good for following real estate. The first four I picked were fairly obvious: the S&P 500, and then following the MSCI for Eastern Asia, Europe, and I can't remember what it was basically equities excluding Canada and the US. And then the last two I chose to look at were the Treasury yields, both for 3 months and 10 years, which aren't necessarily an index, but I thought given the importance of where those rates are, they'd be really good for predicting where we are in the future.
Good, okay, that's a great start, So let's just take a step back for a second. Why are we doing this to begin with? What is it helping us to do?
Good day. So, I think we're doing this because we can look at all of these different indices and help. It will show us, they provide indicators on how the market or the economy is going and what direction it's going, whether up and down, and so that can then inform our decisions, our investment decisions.
Okay, so who are we again? We're CalPERS, we're an institutional investor, and we have $100 million US to invest over the next, let's say we need to put out the money, invest the money in the next 2 years, but that money is going to be invested into real estate in the next, let's say 10 years. So why again do we need somebody else? Why again do we need to do this?
To see where our money would be better spent, using kind of seeing if there is a relationship between these indexes. It would make us, I guess, make better decisions of where to invest.
Based on, what are we doing?
Global trends.
Risk.
Risk.
Right, we're looking at risk, but what are we specifically doing? We're looking into the future.
Trying to predict.
Right, we're forecasting. We're weather reports. We're forecasting. So what did we looked at last week? We looked at where the recessions were, and we saw that where some of the indices followed very religiously to where the recessions were. Right, so there's a high correlation of like 1. So what we're doing, what we need to do is look at these indicators to tell us how we're going to invest, to predict the future. And what have we been looking at? We've been looking at what it is that impacts real estate. So, right, we're looking at what's going to happen to treasuries. And why do we care about the treasuries? Because we want to have a certain cushion, a spread, over treasuries to make sure that our investment is good. Because if it's going down, if we think treasuries are going down, it's one thing, if it's going up, it's another. What else do we need to look at in terms of forecasting? So you chose the real estate, you chose private and public real estate markets.
Yep.
Okay.
I mean,
Is that going to be a predictor for us?
So I guess that's where I had some of the confusion, because I was looking at indexes, but I guess the other things I was looking at were more like the indicators, so in terms of like employment and job growth and manufacturing, things like those.
Exactly.
So maybe I misunderstood the assignment a little bit, that's picking just indexes, but.
There's no right or wrong in any of this, right? And all of that what you chose are excellent choices, but I'm trying to just like refine it to say, what is it that's going to give us the information to make the decision? The NAREIT, which is what? The private real estate, right? National Council of Fiduciaries. That's the private real estate results. And we do need to look at that.
It's more backward looking than it is predictive, I guess. Which is the
although you can start to look at trends.
Yep.
Right? So you can look at trends and say, oh, it is going to be helpful. But there are other indicators for the economy, for growth or lack of growth in the economy that will tell us or give us a clue. What do we look at? Like last week we looked at CMBS, right? There's a lot of CMBS out there. What's the default rate? And things like that are going to start to give us, what else? What was the one that was like the basket, remember?
CPI?
No.
LEI.
Right. The leading economic indicator basket, which grouped together a variety of different indices to give us a clue. about what could be coming down the road or not. Go back and look at the slides from lesson 2, and you'll see there's a page with like all the little flags that show it was like Australia, China, and Japan, I think, the 3 countries that were using the LEI as an indicator in terms of yes or no, go or no go in terms of investing in there. Because remember, you guys are going to have to make a decision shortly on which countries to invest in for your portfolios. So you need tools to figure out how you're going to make that decision. And that's what these tools are going to help you with. Okay? Anyone else want to talk about which they chose? Yeah.
So I chose similar ones, but the one that I chose was different, was this CIMI, Cities and Motions Index. I just thought that was interesting because it was tracking like human capital, entrepreneurialism, like social indicators in major cities across the world. So I thought that like when looking sort of at how these major cities in different countries are growing or waning, it could help inform investment and predict sort of what real estate values are going to be in the surrounding areas. So,
Right, because what is that going to do for us? It's going to make a comparison of different cities and see the health or lack of health of some, based on these more what I call soft kind of metrics, but they're important. One of the big issues now, if you look at how, remember the whole conversation about Amazon making a decision about where they would go to build their second headquarters, part of it was based on human capital. Exactly to your point. That if you don't have the human resources to fulfill jobs, you're sunk.
Exactly.
So that is a very good indicator actually in terms of where progression, where growth is. Part of it is, again, we're forecasting, we're looking into the future. So we need to be able to say which cities, countries are going to have that growth. Where do we want to put our money, not in a place that's somewhat stale. And we started to look at the end of last session, demographics and the aging population in a place like Japan especially, that has I think it was reached like 50-60% almost in people who are over 60 or retired. That's significant. If you're making an investment, remember, we're looking at private real estate to make the investment in for the purposes of this class. We look at public as a comparison, we need to know about it. But so we're in it for the long haul. So that's part of the growth story. And then we're going to look at the asset classes and such. So, anyone else want to share with Brenda?
One of the indices that I looked at was the FTSE IPRA and IRE Global, because it included developed and emerging markets. So I thought that was, a good addition.
Good.
Versus the other one that is the developing index. It was just worldwide investment emerging markets or something like that.
So that's going to tell us the public markets, how that's behaving. And so as a private investor, how is that going to help us make our decisions? It's going to talk to and tell us some things about how other investors perceive the marketplace. And it's going to also because it has the volatility of the public markets, so it's a little skewed, but it's still a good indicator of investor sentiment. It's also a good, one of the things we'll be talking about is transparency in the marketplace. And the countries that have the REIT markets are typically the most transparent in terms of, what do I mean by transparent in the marketplace?
Available data.
Exactly, information. And how are we making our decisions? We're making our decisions based on information. So following something like the FTSE NERI European Index is going to give us a view into what's happening in the European markets, number one. And number two, it's going to talk about the investor sentiment for that region. It might not be a great predictor necessarily as much as give us insight into that marketplace. Anybody else?
So apart from, oh sorry.
No, go ahead. Go ahead.
Sorry, far away. I
Right.
apart from like the regular indices, one thing I focused on was finding something within my own home market, which is India.
Uh-huh.
So I did find a real residential property index, which it has seen a latest slump. Like it is trending downward, and I want to keep track of like where it is going and what are some of the factors which is making it trend lower. And it had a good assets under management, like the amount of
The large size of the market, the
right,
size
so
of the
the size
index.
of the index was quite big as well. So I thought that was specific to a country and specific to an asset type in a country, which is interesting to me.
Good,
Yeah.
okay, good. Yes.
So you can use this laptop.
Okay.
When you need picture, just press this one button.
Okay,
Yes.
great, thank you so
This
much.
is-
Okay, I appreciate it,
Alright,
thank
so
you.
don't touch this one, just use.
Right, okay.
Thank you.
Got it. Thank you. Okay, all right, so, anybody else? You want to say something?
Oh yeah. So in addition to the S&P, I chose the Barclays Global Aggregate Bond Index, just because they were negatively correlated, and then I chose MSCI World and MSCI Emerging Markets, and then the CSI Cross Rates 500, which is a Chinese index, just to sort of balance out that with the S&P 500.
Interesting, okay. All right, so here's the thing. So what I think you all chose really made good decisions. What I'd like you to do is go back and give it another thought, whatever, to answer the question for yourselves. Am I selecting the indices that are going to help me make investment decisions? And your investment decisions, your decision tree, as we say, is based on which countries you're going to invest into. Okay, let me repeat it again. The indices you choose will be to guide you into which countries to be investing in. So are they helpful in making investment decisions for future investment for your real estate portfolio, your global real estate portfolio? So I did something for all of us. I contacted IPD. And I told, so remember IPD? So, right, okay, we're good. So IPD, again, the private, was bought by Morgan Stanley, now it's MSCI, IPD. And I told them what we're doing. And so they might do some work with us. And they're going to give you access to a bunch of things. So it's gonna be interesting. So he sent me an email, but I was running out to come here. And so I'll see what he had to say, and we'll talk about that again. Because I think that understanding that world is important in terms of helping us make good, informed decisions, but it's also learning how to use the indices in a critical way. Not just, there's the S&P, there's this, what is it really telling us? What do we mean? So, okay, so did everyone see that I submitted the first assignment? Okay, so it's not due yet. We're going to discuss it at the end of the class. And any questions during the week, I think it's not due till October 2nd, I think it is.
Yep.
Okay, so you have some time, and you can bring questions. Next week is not October 2nd, right?
Yep.
So, you have I give you plenty of time. I also gave you an article to read. It's a very dated article, but it's one of the best write-ups, I think, on what we're learning in terms of thinking about how to look at investing in another country from outside of your country. And Barden Gale, who was actually a client of mine, worked together, and he was at one of the largest pension funds in the world doing investing, and he and one of his colleagues there wrote the article, and I just think it's very well put out. I have one of the examples, the mathematical examples of how they calculated some things, And it talks about the premium that's needed to invest in other countries from wherever you're coming from and how to approach that. So we're going to go over that. Okay, let me get myself organized here and not touch that machine. Where this.
So we got soundtrack for the class.
I know. To be able to compete with it, that's for sure. Sorry. Oh, here.
Are you familiar with the Macs?
I am familiar with Apple, but for some reason I'm not finding where unless maybe it's not right. If anyone else can help. It's not right. Thank you.
到最后大家选的不一样，这边真没去过，什么是真的说？
Doesn't look all right. It's not opening. Oh, wait. Okay. Okay. Maybe it went down into PowerPoint. there it is. Where was it?
Stuck. It was like, I think a full screen, so it was just stuck.
Now, that seems to be on.
And then wait for start. And then this one. Or wait,
Now,
the-
it's green.
I think the actual. Oh, I just turned it off.
Right. Oh, no.
Hopefully it'll work. It's on. You good?
Yeah, okay. Thank you so much.
Sorry.
Okay, thanks. All right, here we go. All right. So this is interesting because it's just another look at the marketplace, and they're saying, you know, we spoke about the size of the market being really important, and this is saying that for the most part, North America is less than half. I mean, it's still a major portion of the whole global marketplace, but it's less than half. And then you divide between APAC, Asia Pacific, and Europe. And Europe being so close to North America in size was also, in my mind, it's quite astonishing. So the takeaway from this is that this looked very different. Remember we looked at last week, I think it was, I want to say $5-6 trillion or so, but the breakup was different. And what I'd say is you have to look at who's counting and how they're counting and where they're counting from. In terms of whenever you're looking at data, generally, and nothing, I'm not saying anything's wrong, but just to highlight that this is a little bit different story than what we were seeing in the other reference slides. So, and this is exactly what we started to talk about, the Global Cities Index, and looking at how do we start to compare different cities on a global basis. And so what these people use, and this was A.T. Kearney, which is a consulting firm essentially. And so they use business activity, human capital, information exchange, cultural experience, and political engagement. And even ranking cultural experience is 15%, somewhat high. But it just starts to give you a breakdown in terms of you're starting to now think about how you're going to select your countries and now your cities. And these are some ways that people differentiate what's happening in different cities. And you better believe that someone like Amazon did look at things like this to really understand where the opportunities might be coming down in the future. And this is just more of a breakdown of what they looked at. So, and what's interesting here is they give you some of their thinking about what went behind the processing the information for the different categories. So you looked at top global services firms, capital markets, air freight, sea freight, where the top universities are, because that's going to be really critical in terms of being able to get fresh, new talent, international travelers. If you're looking at investing into hotels, you know, that's something like that's going to be really critical. So these are the types of measurements that groups will use to quantify these different areas. And you know, there's no real science to this, is what I would say, but it's an interesting way of looking at making decisions for this kind of paradigm. Regulatory environments. How hard is it to build a building? What are now all the different green metrics that are going to be imposed, both from the investor side as well as from governments and other bodies. So you do need to look at that kind of issue when thinking about moving overseas. So that's the ease of doing business. How hard is it or easy is it to get your capital out of a country? If you're investing into another country in a foreign currency, can you get stuck there? The answer is yes, you can. China's not, and China's regulations have gone back and forth over the years in terms of being able to actually exchange your currency to get out. So that has a huge impact on people making decisions. Urbanization rate, we spoke about that the world has reached beyond 50% in urban areas now versus rural. But where are the places that are growing? If you're looking to really get higher kinds of returns, you start to look at emerging markets as an example. So that's a really good motivator for trying to get to higher returns. But where is that urbanization happening, which will lead to the need for different types of real estate than what's already there, and hopefully you will get paid for that. We spoke, and this is an old chart, I know, but I left it in because I couldn't find something that was comparable in terms of the actual size of the markets. And you look at, again, everyone has measures differently, and you know what's an office building versus not an office building, etc. But according to this, back in 2013, over 50% of today's commercial real estate market is represented by 5 countries. Now, that within itself is going to somewhat limit you in terms of where your global portfolio is, how broad your global portfolio is really going to be. I think that's the big message here. I mean, we're looking globally, and we're looking to make a diversified global portfolio. But at the end of the day, there are really a limited number of countries that an institutional investor, remember, because we are this public pension fund, that's our hat, that you would really be accepted to invest into. I have seen some institutional investors move into Africa, but those have been a rare few, and that's more like the foundations and endowments who have a different kind of investment model, and they take higher risks, they want higher returns from their real estate portfolio. But traditionally, you know, you're looking at a handful of markets that have the ability, what's one of the first things you're going to be thinking about if you're going into a market? Can I get out of the market? So what does that mean? How does that translate? What are you looking for at that point?
Liquidity.
Exactly. So what's a good sign for liquidity that we've discussed in real estate?
Transaction volume, or?
That's a good one. That's a very good one, yes. What else? We haven't discussed that, but it's a good one.
Legal.
Well, yeah, you do, yes, because you do want to see that there are regulations and things, and yes, that's
Protect your money.
right. But the REIT market, it's like what Brenda chose, right? So you want to see that if there's a REIT market, that shows pretty advanced liquidity for any particular country relative to real estate. Because why? REITs can buy your real estate. And why else is that also important? Today is like really weird. Great. I guess
Oh no, they had an announcement outside. No, I'm not gonna say.
Wait, what?
It's a
About that them testing this out and that it is not a warning.
I'm going to walk out and go find out.
Sure.
I'll be right back.
Yeah.
Well, we should probably find it out.
If you see me run, wait.
Not
run,
5 minutes
run.
have left.
We jump. We survived 10 first, no we? No, we followed.
Breathe again. So we're talking about, so why would we want REITs to buy our property?
Tax benefits?
Well, we don't care about their tax benefits.
Isn't there a capital gains benefit from selling to a REIT?
No, not that I know of. That'd be good.
Isn't that the whole point of a REIT, was to defer capital gains for the person selling the property?
No, not on a global. Sorry, not on a global basis. No. The reason is because they have. Well, you're in that right realm. So the point is, they have different financial analytics and barriers and opportunity costs than a private side. So where the private is looking to give, you know, like what a NCREIF return is, public is having a different kind of return, and they have to distribute all of their income and such, so their, what their goals and objectives are different than ours. And sometimes you can look to create a spread, an arbitrage between the public and private markets by selling into, if you're a private guy, selling into the public markets. Does that make sense?
They're willing to pay more for your
Possibly.
asset because they need.
They have to get the money out. I mean, everyone has to get the money out, but they might have to look to investing in a different way than the private side, whereas the private side is looking to get an appreciation and income. It could be that the REITs are just looking for income and not necessarily so much appreciation, because that's what they're distributing. And there's different moments in time in terms of what the different pressures are for each of them, but it's something you could even follow in your analysis for making investment decisions, is what is the difference between the REIT index versus, so the NAREIT in the US versus NCREIF. Because that would tell you that there's a spread, and that could be interesting. So the bottom line of all of this is you do want to see in a market that you're moving into that there is a public market, because that will create opportunity for A, liquidity, you know that they have capital to spend, and B, it might be a good buyer for you if there's a difference in terms of pressures for how the REIT has to sell versus how the private investor has to sell. Okay? So, I don't know how I got off on that, but, so 5 countries, and you can see how, again, this is a while ago, so it's definitely changed. But the point is, it hasn't changed that dramatically in terms of like adding 10 more countries, maybe 2 more that matter and stuff like that. So here again, another looking at comparison of economic growth, investment volumes, exactly what you were saying, that how the investment market has been growing or not growing, and the changes in that marketplace. And prime yields, do you know what prime yields are? So prime yields are for essentially yields for prime property in major central business districts, major markets.
Is it
So-
core yield?
Yeah, it's close. It's not necessarily the same, but it's
Similar.
Yeah, it shouldn't be that different. But it's for a very good property that typical renters will be paying for rent in that very strong marketplace. Okay, so these are some of the other metrics that you would look at, that we were speaking about before, about more like some of the soft ones, but this married with the economic growth, investment trades, how much it's changed. If you see a market that's already gone through a major shift of like 30% change in volume from year to year, you might not want to go into that market at this moment in time. You might want to wait and sort of follow that. So these are clues in terms of where are you entering a market at a particular point in time, because each market has a cycle. It doesn't stay constant, so it's always going to change. So it's always, sometimes it's also, you might pick a country, and you might pick a city, but then you'll see that, and you want, let's say, office buildings in Sao Paulo, but you see that Sao Paulo is sort of at the height of its valuation on a relative basis to the last 5 years or so, and you say, you know what, I'm going to wait until it starts to come down. And you'll start to watch the transaction volumes, you'll start to watch the rents, the prime yields, and see how the values start to move, and wait for your time to pick to go into that marketplace. We used to do it with LaSalle, they still do a clock, a property clock. You can look it up and find it online. It tells you, it shows the world, And it shows you where each city is in the world, in most of these institutional markets, on a relative basis. And what they do is they do it based on valuations, rents, vacancy rates, and things like that. So that, combined with what we're looking at from the indices in terms of like the leading economic indicators, all of a sudden you start to get a really good picture of forecasting, both from the economic side and then marrying it to the real estate side. And then you can start to make investment decisions much more on an informed basis. Oh, here we go. So here's in India, so this was construction forecasting, looking at what's needed. That's the other thing. So we started to touch upon demographics last week. We finished that up. We'll build that into what we're talking about. So if you are a residential developer, you want to see what population growth is looking like, and where is the population shift, and what is the age of the population, because that's going to dictate how much people can afford to either pay rent, is there a mortgage marketplace, etc. And we want to, again, if we're taking a step back and making our global portfolio decisions, look at some of these places in terms of where housing completions are projected to be done. Yeah?
It's funny that you mentioned the availability that we need, and as of now, currently the market is oversupplied. It is oversupplied with luxury apartments rather than affordable sectors, especially like in a country like in a developing country like India and China. Developers should much more focus on the affordability of those houses.
So this is a problem around the world.
Yeah.
This isn't unique to developing markets. Right here in New York is the same problem. I was reading that I think the luxury market now for residential building is something vacant like 25% or something, right? 1 in 4 or something. So 25% vacant in these luxury apartments. Yet there's a housing crisis here. That we don't have enough residential units to meet the population demands. So it's a crisis. Because why is this? Why is this a global price? Why is this happening? What do you think?
Do we offset construction costs? Sorry. To offset construction costs, I mean, and the
Right.
location benefit. I think it's location.
That's a big piece of it, right? But that's right. Go ahead.
You know, again, you said that this is worldwide, and this happened in Peru. Also, we were at the beginning, maybe 5 years back, we were building homes, and at the beginning they were luxury homes, luxury apartments, and they sold immediately. And then the market, like after 3 years, it was like oversupplied, and we started seeing that, not that we didn't know that there was need for affordable housing, it's just that, people were buying the luxury because there was also a need in that area. And then, for example, like I talked to, I don't know if you're familiar with Paladin.
Yes.
Paladin, 5 years ago, was very heavy in Peru. They still are, and they were building luxury apartments for sale. And when I approached them, because I know someone there, I try to tell them like, look, you're in Peru, but what the country really needs is affordable housing. And he told me point blank, there is no money in affordable housing. They want to make their money and get out. And he said there is no money. Now they are building somewhat affordable housing.
So remember that. Thank you. That's really interesting. So it's global. It's a global problem.
It's global, and it's just the reality is, like he said, there is really no.
Well, so remember we discussed, I guess last week, Stuyvesant Town, Cooper Village, that Blackstone paid $5.3 billion. That was built as affordable housing. There was MetLife building it for workers.
But that $5.3 billion purchase was based on making as much as possible not affordable housing. Their plan was to unregulate almost as many units as possible, upscale the buildings and sell and charge a lot more than they
Over a
they
period
were,
of time.
which is why they've twice stopped doing it, because the first time the financial crisis happened and the second time they just put a rent control and they've stopped.
Well, the rent,
doing
so
all-
that's where it's going. So there's rent control. So you have places like New York, you have places like San Francisco, and you have, I'm not sure where else in the world, if you have any rent regulations in Peru, but, that's part of the problem from the developer's perspective. What we've had here is, the administration, the Trump administration passed, for opportunity zone investing, which you might be hearing about, Oz, opportunity zone investing. And it's a huge tax break, essentially to encourage developers to go into economically challenged neighborhoods to build. Problem is, it's very untested how it really works, and there are a lot of issues right now that haven't been totally flushed out. But you do see a lot of investors, a lot of developers now looking to do affordable housing. Part of it is, we've discussed that there's just so much capital in the marketplace, and they can't find homes to find other places to build, so they're trying to make those numbers work. And sometimes you can, and sometimes they can't, but it's challenging. And we'll see what happens with Blackstone with this. That was a huge bet. And you can't just ignore the rent controls. And the rent control, and we talk about politics, we said politics is something that is part of the decision tree. This is a reason. The rent control laws changed, so what happened? Blackstone bought it, 3 years, 5 years ago, whatever it was, I don't know how many years
I
ago.
think it was a lot
More?
less than that.
Oh, less than
To be
that?
honest, because it was with a special servicer from the
from
the Tishman
Tishman's
collapse for
buyer.
like 10 years after. I think it was 2018.
Oh, was
when they
it?
actually closed.
Okay.
But
all right.
Blackstone was one of the main creditors from the Tishman sale, so they've been tied into it for 10 years.
Okay, so so the point is though that they did their forecasting based on one set of rent control laws, and they got the rug pulled out from underneath them because the rent control laws changed.
It
So
also,
their whole underwriting has to be changed.
I was gonna say, it also goes to show you, if there's anyone who's probably tied into politics, it's a company like Blackstone. If they can't even
Figure
figure
it out.
this out, then how can the average
Right.
person or middle-sized company possibly consider that?
Right, that's a
We
very
probably
good point.
like relationships at all
Exactly.
levels of government.
Right. Yes.
I read that they were also gonna warehouse
Yes.
and like,
Yes, like
There's that
they put aside like 50, 60 apartments already that they were going to do capital improvements on, because that was how they were able to increase rents. Landlord in New York puts money into capital improvements, into residential apartment, they can raise the rent to amortize some of that cost. Now that's changed. So, point is, there is this but we need to look at this, and residential investing has been the hottest market from an institutional perspective for the last, I don't know, 5, 7 years or so. So, we look at this. Now, do you have enough guts, to go do some of this there? But that's where the opportunities lie, not in the US. And we're going to look at a chart in a little bit to match exactly what we're talking about, the population and what the real estate market looks like. Because that's how refined you can get.
How,
And you should get.
how reliable is the data on China? Because I work with brokers there all the time, trying to get this information about the housing, because most of it's developed by the government. We don't have insight onto that information. And then I've got a lot of property that happens to be in these enterprise zones where the government wants to convert it into housing. So does that, what's the source for that?
Did I put the source down here? Global Construction 2025.
Is it from,
So here's what I would answer you. I would never believe any of it. In a lot of countries, I don't like to use the word lying, but I'm gonna say it. Lying is acceptable. Or not telling the truth, let's look the other way. Not telling the truth is acceptable. And there are a lot of countries where numbers I just don't believe. However, you need something. So there are plenty, what I would suggest is there are plenty of consulting firms that's what they do. They go in and try as best they can. I wouldn't say that you use that as the Bible, but it's a guide. And it'll give you some clue, and part of it is to watch. It's not so much one number and point in time, but remember we've been talking very much, everything it's not absolute, it's relative. So look at something over a period of time and just look at what the pace is or what the dynamic changes are. And that will give you a better clue. Whatever. Anyway. The music and your computers. All right, so we discussed this. So does that answer your question?
Yeah.
Okay. So, all right, so this chart is a good chart to break down the three pieces of the puzzle. And I wanted to focus a little bit in on the second one. So I've touched upon it, but it's probably somewhat of a new concept to a lot of you. And it's how a lot of real estate is owned at this point. So we've spoken about CalPERS and the pension funds and sovereign wealth funds that have all this capital to invest into real estate. But they don't do it by going and buying, like CalPERS has, I don't know what their number is now, like I don't know how many billions of dollars, but a lot of billions of dollars in real estate. They don't go about doing it by buying one asset at a time. And most of these pension funds don't have sufficient staff to do a lot of this investing. So what's happened is the investment management world has grown up as a result of that. So investment managers are the Blackstones, the BlackRocks, the Brookfields, the LaSalles, JP Morgan from the banks. They'll have an investment management arm. And what these investment managers do is we create an investment pool. So you know if you have bonds or stocks and you have a mutual fund, so what does the mutual fund salesperson, what do? The fund manager. Fund manager comes up with an idea, target return, a value add, they want a little over benchmark, 200 basis point over index, let's say, and they're going to get, mix it with a lot of different types of strategies to get to that return, but it's an overall arching one kind of strategy. Maybe it's just all Fortune 500 companies or whatever it is. We do the same in real estate. And these are called traditionally private closed-end funds. And what will happen is one of these managers will come up with this brilliant idea to do an investment strategy. Let's say we're going to do Midwest logistics buildings, okay? So that's what we're going to do. We're going to invest into Midwest logistics buildings. We think we're going to be able to produce a return somewhere, around a 12% total IRR net to the investor. And the manager says, I know I can build out this portfolio and I can invest, let's say, $100 million of equity. And I'm going to leverage that equity, 75%. So I'm going to be able to invest $400 million into real estate. And I'm going to propose that we're going to get, or predict that we're going to get a 12% IRR based on about a 5-6% yield. Okay? So what these managers do is they start to look at the properties, then they go knocking on the doors of the institutional investors and say, here's our fund, give us your money. And these funds have traditionally they have a life of maybe 10 years. So the manager raises the money, invests the money within a certain period of time, usually 2 to 4 years, manages it, makes whatever changes, and then sells it and gives back the money. There's a lot of money to be made for the manager because there's an asset management fee based on the equity, and usually that's somewhere between 1 to 2%. And then there's what's called a promote, or a carried interest, you might have heard of. And what that is the manager says, I'm creating value. I should participate in that value I'm creating. I don't have to invest necessarily, and they have to put in some money, but they're not making the return from the carried interest based on their investment They're doing it because they've done this great job and they're the manager and they did this. And those that promote can be hundreds of millions of dollars.
That's only if they
If they
invest
do well.
successfully.
Although, there was a time, it's changed, where the promote was based on deal by deal and not the whole portfolio. So what does that mean? That means you can have, let's say you had 10 assets in your portfolio, and let's say 8 of them did really well and you made your promote, you hit your hurdles and all sorts of things based on IRR typically, which is the wrong metric, but whatever. But the last 2 were the dogs, and you couldn't sell them. And you took a real hit. And you lost money, you lost equity. So it could have been that you, the manager, made a lot of money in your fees and your promote, your carried interest, but the investor lost money. So finally, some people got smart, and for the most part, it's very rare to see that. And so now what traditionally is done is the carried interest is based on how the whole portfolio does and is paid at the end. Okay, which is much more fair.
Is there a return that's guaranteed for the investor?
No,
Not.
there's a preferred return. So what will happen is, it's called a waterfall, how everybody gets paid. And that waterfall will depend on a preferred return. So the investor gets their equity back, then they'll get like a 6 or 8% return, depending on what the strategy is, where it is, and all sorts of things. And then you start to split the profits. Then you start to divide the profits up. And then there's fee structure splits within the profits after that as well. But it could be that's how most of these investment managers made a ton of money, is through that mechanism.
So are they only gonna, so if they're holding a asset for 10 years, right, and the hurdle is based on IRR, then the like sponsor is only gonna get their promote upon the sale of the asset, right? Because they're not gonna be able to.
But now,
hit
and
those
what I'm telling you
numbers.
is at the end, when everything's sold and done.
Yeah, okay, so it's
at
on the
very
back
end.
end,
It's the back,
yeah,
right.
okay.
But it used to be,
Interesting.
so what happened was, so IRR is what? It's a time-weighted return,
Yeah.
right? So the shorter you hold, the higher the IRR, right?
Yeah.
So what does that mean? So the shorter the IRR, the shorter the period for hold, the higher the IRR, the higher the promote, the carried interest.
Yeah.
So what some managers were doing, where they're like buying it and then selling it.
Conflict of interest.
Hello. So there was a lot of games being played.
Yeah.
And it's also how you calculate the IRR. So,
Yeah.
but the big thing was, you can't just sort of like flip it
Yeah.
to just, get the IRR off the
Yeah.
ground.
Yeah.
That really is not a good thing.
And if you need more time of those 10 years, like 15 or I don't know, an extra
Can't.
5.
You can get,
What happens?
so typically the way it's done is it'll give you get like, so there's an advisory committee that's made up of the investors, and they get votes on critical issues only. And this would be a critical issue. So if they said, you know what, like with the global financial crisis, a lot of stuff happened, and they said, this isn't the right time to sell. Let's hang out if we can afford to. So then the advisory committee made up of the major investors would vote and say, okay, we'll give you another whatever. Now what they might do is cut some of the management fee, but it depends. So these are, so when we're looking at the NACREIF, the NPI, and the IPD, well, NACREIF specifically, this is what these things are meant, these private funds. However, there's what's called ODCE, ODCE, which is the Open Diversified Core something. I don't know what the E is for, but they're open-end funds. And that is a huge piece of the marketplace. And what that means is exactly what it sounds like. So we had closed-end, the door's closed in terms of the time. These are open-end, the door's open. There is no life ending to these funds. So in other words, you go in, and these are all, traditionally, these are core funds. The fees are a lot lower. A lot of times there's no promote. A lot of times there's no debt. Depends on the manager. But that's another huge vehicle for investing into real estate, more core-like real estate. And people will follow that index a lot because it's sort of like the basis. And the problem with those funds have been historically, when one wants to get out, typically a lot of people want to get out of the fund. So there's like a run for the bank, right? There's a motivation, something happens in the market, I want my money out. And all of a sudden everyone's rushing and there's not enough cash to pay everybody back. Because remember, it's an illiquid asset. So where do you get, so they've put in certain types of mechanisms to sort of stop that from happening. So that's become a very, very, very popular way. And the institutional market that we've been speaking about have been the pensions and insurance and what we've been saying. However, there's a whole other marketplace that is way bigger than this market. You know what that is? It's the individual retirement accounts, what we all have. So a 401k or an IRA here in the US. So remember we spoke about, it used to be that the corporations would pay pensions to their employees. And when we said they moved it away from their balance sheet, to clean up their balance sheet liability, and they moved it to the responsibility of all the likes of us. We all have these individual retirement accounts. Typically, what do you invest in if anyone has any? Invest into stocks and
Equities.
bonds, right? So you can buy REITs, but you buy stocks and bonds typically. So now, some firms like TIA Pref, or what do they call themselves now? Nuveen, or whatever they call themselves. No, I forgot the new name. But anyway, they have figured out a way to allow individual retirement accounts to start investing into private real estate funds like this that I just described. Huge. Way they're doing it, because remember, we're little, we're little peanuts. We're just, but we need to be able to get our money out. So what TIA has done is they have backstopped. In other words, they are guaranteeing from their balance sheet to be able to get you out when you need to get out. So not everybody can do that. If that starts to, and then there's another product called like a limited property trust that any of us can go into, like LaSalle has one for core funds, core assets. And that's growing, not hugely, but it's growing. That's another way for individuals to start. So there's, I guess I just want to introduce you to the fact that there's another whole marketplace that's coming, that's growing, where the managers are figuring out how to let individual retirement funds into real estate. And that market is several times the size of what we've been looking at. So that's something to really follow.
How do they pull them together?
Well, so like a TIA, so Teachers Insurance has daily pension funds for Carnegie had started that, and that is a pension fund system, insurance companies started with pension funds for people of higher education, so for professors and stuff. So they have a body of people. So the LaSalle Property Trust, they just market it. So they will go out to like someone like a Fidelity or any of these kinds of wholesale retailers. They will market the real estate product to these wholesale retailers to then sell to the doctors and dentists and accountants and this one and that one. So they use all the different financial people in the marketplace to market to.
Is it possible to focus on based on occupation, based on it?
They don't really, I don't know that they do that. It's more regional. So there's a guy sitting in an office at a Fidelity in, Dayton, Ohio, and he has his clients that are in his region that he markets and he sells stocks and bonds to. So now all of a sudden he'll have he'll have, another, you know, tool to, another something else to sell, real estate to sell. And people love real estate, right? So, look, you know, they look at that and they say, oh, I can get a 5 or a 6 and a strong return, you know, certified by leases and such.
Does that reflect, for TIA, does that reflect as a liability on their balance sheet?
The liability would be how they're backstopping it, but the fund itself would be an investment product that would be distinct.
Oh, I see.
So the person who manages the investment for a 401k, for example, and they choose the different funds that the people are gonna invest in.
Exactly.
So they can choose this product that the real
Correct.
estate and put it in there, and then everyone else will put in their money.
Correct. That's how it would
So
start.
this product does exist.
Yeah, but
It's just not about-
it's not widely used or marketed at this point. Because it's not easy in terms of being able to commit to the liquidity. So that's been the real issue. The people need to be able to get in and get out. So that's the problem. So it hasn't really taken off. But I think some very smart people are looking at how to, and I think TIA's done a great job in pushing it.
How do you secure the properties while you pitch to the pension funds?
That's a
for
good
the
question.
money?
So they could end up, they could fund it themselves and then get paid back. Or what they do, what a lot of these investment managers will do is they will put together a pitch book that has prospective deals. So they'll be in the marketplace, they can't take it down because they don't have the capital, but they will try to talk them into waiting for them. But a lot of them are just like, these are types of deals that we would look to buy. So it's a little bit of a catch as catch can. It's not easy. So that's a lot of the structure of how real estate is owned in the, not just the US. And so these funds are global. They're like Morgan Stanley or Blackstone did $20 billion of equity. Their latest fundraise for a global real estate fund. $20 billion of equity. They're going to leverage. So what do? They're not buying, right, little assets. They're buying companies, they're buying major portfolios. I think Brookfield, the last one was $15 billion. I mean, and what's happening is these fund managers, it's becoming the very, very large gorillas, and then everybody else. So there's a huge distinction between them. So that's all to say, yes?
Sorry, and
No.
why don't they wait like 1 year or 2 years if like where everyone is speaking about global recession, or like in 2 years probably the assets are gonna be
Let's look
cheaper.
at that. So let's say I'm right, and let's say just 1%. So they raised $20 billion, and the asset management fee alone, is, let's say it's just 1%, it's probably more. So what's 1% on 20 billion?
200.
So let's see, 10% of 20 billion is 2 billion, right? So 1% is 200 million. That's why. They're making $200 million in that year in asset management fees alone. You get it? Right? Part of it is they can't let the music can't stop. If you can raise $20 billion, you think you're going to sit and say, oh, no, go away, we'll wait. Right? Who would? To be honest. Because that money can go away and say, oh, I'm not giving it to you anymore. That happens. But they're raising $20 billion. Now, thing is, they have a reputation, and I know the guys over there, they're good guys, they're smart people. And they have to perform. But they, part of it is, they all think they walk on water now. That they're going to just be able to buy and do whatever. And they'll, you know what? They'll go and they'll buy public companies and take them private. They'll do all sorts of things. They will find ways of making money. Whether or not it all works, that's questionable. And you could go onto the public pension plans websites, because they have to report everything. And you can see the returns from, so let's say CalPERS. I promise you CalPERS is invested into Blackstone. CalPERS website, you'll be able to find what Blackstone's returns for some of their private funds are. Because what do we say? The public information for the public REITs is all out there. The private information is very hard to get, and that's why we look at the private indices. Because you can't, none of these fund managers are going to give you their returns unless you're a prospective investor. So how do you get them? You get them by going on the websites of the public institutions, the public pension plans, who have to report it into the public domain, and you can see what the different returns for the different funds are for the different private equity, private real estate equity firms are. So you can go see, and I've done this, I've done whole analysis of like some of Blackstone's work. And there's some good returns and some not so good returns. But that's why they're doing it. That's their business.
The leverage is with different banks, or it's like.
So that's a good, so another aspect of all of this is the leverage, and there are funds that just do so we're talking about equity now, right? This, the equity that they're raising and investing in. There are also funds that just do debt. So Blackstone has a private debt fund. Brookfield has a private debt fund. All these places have private debt funds. And so what is that? That's a fund, pool of assets, of capital that's targeted to place debt, to be the mortgage for these different real estate projects. Now, it shouldn't be that the debt guy from Blackstone's giving the equity guy that loan. That'd be a little, you know, but yeah, they can go to banks, but these private equity firms, these private real estate firms, I shouldn't call them private equity, private real estate firms are taking business away from the banks and the insurance companies. They're one of the largest now sources of debt in the marketplace, so these private real estate funds. The billions and billions. We can go look, someone can Google it. You can probably go see what Blackstone's latest private debt fund size is. It's probably tens of billions of dollars. I don't know. So that's the marketplace that you all need to be very aware of, because that's the marketplace that's going to affect how this market moves. And these are also great opportunities in terms of employment for you guys. Because these are the markets that are going to control, these are the groups that are going to control most of the real estate in the world. This is where it's going. It's not going, it's there. It's here. It's right. So this is really critical. These are the 3 ways of owning real estate. And the second one is what we've just discussed. And why is these pension funds do this? Because they don't have the skill set. They have so much money to put out, and they want to diversify. So they'll give all these different managers different pools of capital to invest in these different strategies that they can't do on their own. And they end up with a very diversified portfolio. I sent you all CalPERS's real estate web link. Go look at it, because you will start to see the different funds that they invest into and the different strategies. And you'll see the names of the different managers.
In Canada, the 2 biggest pension funds have their own, essentially, real
CPP,
estate companies.
yeah.
They have, well, the 2 biggest ones I know, Oxford
PSP.
and Ivanhoe Cambridge, which
Well,
is
Ivan is Caisse de Dépôt.
Yeah, exactly. So my point is those 2 funds go and they basically have their own real estate companies that invest directly. They often partner, but it's not really seen in the U.S.
So
context.
that's a great point. So what he's saying is that there are marketplaces in the world, not just Canada. It's really Canada and Australia and the UK a little bit, that where the pension funds got tired of paying these huge fees to these managers. They said, we should be able to do this. This is crazy. We're paying millions and hundreds of millions of dollars. So what did they do? They said, we're going to create our own firms ourselves, our own managers ourselves. And so CPP, which is Canadian Pension Plan.
Yep.
Ivanhoe, which is part of Caisse de Depot, another Canadian pension plan, have hired groups of people
And Oxford as
in-house.
well.
And Oxford, right,
Which is
in-house,
Ontario.
to do their own investing programs. And some of them now have branched out where they take other investment money in from other pension plans. So the pension plans are finally getting smart enough to say, we can do this. We don't have to pay, we can pay salaries at a fraction of what we're paying in fees and do this ourselves and get the same results.
Well, they're even earning fees now too.
That's what I'm saying, right, they're doing their own,
That's smart.
that's what I'm saying, they're bringing in third-party capital, so they charge them fees and they're, right. So, if you think about it, so the managers were like leading the charge in all of this, but it's, in most industries, it's the people who have the capital that are the leaders, the charge, you know, the ones that make the charge. Here, it wasn't, it hasn't been, and it still isn't in most cases. It's these managers, it's not their money. It's the teachers and firemen and policemen's money. So, I won't get political about it, but it's something that's quite interesting in the dynamics of this marketplace. And people don't talk about it unless you're in it. And it's a very esoteric market. So, but I think it's to really understand investing, because they control so much capital. You need to understand how this works and the interplay of all the coordinates. Sorry if I got carried away. It's important, I think. So, all right, how are we doing? All right, so this is the chart I was talking about before. Take a moment to look at this. What this looks at, this puts together the population and the real estate, okay? And looks at the needs versus what's actually the supply. So, somebody tell me, looking at the chart on the left, where would you build something if you were a residential developer? So the can you figure this out? So the inner circle is the population, right? And this is all percentages. And the outer circle is the total residential value. So what's the first thing that you want to look for?
A large difference between the two.
Correct, with the same colors, the same regions. Right, so you want to find where there's a big disparity between the population and the value. So where is there one that says to you, oh, here's a good opportunity of where to build?
North America.
Mm-hmm. Where else?
Europe.
Not really in Europe. See, it would be the other way around. So what Europe looks at is it's 24% of the value versus 11% of the population. So it seems like there's too much real estate, like an overhang of real estate compared to what the population needs.
And the same thing we said for North America then?
Mm-hmm. Yes, totally. Yeah, so you wouldn't be building in North America.
So the Middle East and Africa?
Correct. Right, that's the biggest one.
No, but the value is still high in North America. Even though they occupy just 5% of the total global population, their value is at 21%.
Oh,
So-
you're right. Yes, you're right. Sorry.
So-
right, he's right.
That's
right.
right.
I mean, the
right,
first
yeah.
point was
Right. So North America, Middle East and Africa, and
Europe.
I'm confused how
Yeah.
North America can be one, but Europe can't be.
oh, you're right. I messed up. You're right.
No worries.
Yeah, sorry. Teacher gets it. But so you start to see how that works. And then it's the same thing, but this is total high quality commercial real estate, serious commercial real estate. And then it's also looking at forecasting for the composition of global real estate markets. So look what's happening to Asia Pacific versus North America.
Sorry, could I ask a question about the last slide?
Sure.
So why is it that, I understand you wanna look for a disparity between them, but why is it that you wanna choose the market where it has a low percentage of the global population but a high residential value? It doesn't, in terms of growth, doesn't that mean that it's already a relatively developed market?
Yeah, no, you want to look for where there's a small market but a large population.
A small market,
Small value, large population.
okay.
Right.
So,
So then why
so not North America and Europe then.
Yeah, but-
So why wouldn't China and Hong Kong?
No, so I was right then, so.
Yeah.
Yeah.
Right.
It has to be one or the other. It can't
Right,
be Europe and
right, no, so
Asia.
I was right. So, okay, so, right, so North America you wouldn't, because it's a small population,
Right.
but a very large, you're right.
Okay.
I screwed up, sorry, messed up. So yes, right, you want where there's a small population, I mean, a small value to the real estate, but a larger population.
Sure.
Indicates there's not enough real estate to house, in this instance, the population.
Right,
Right,
That
so
makes
it's,
sense.
it's very intuitive.
okay.
This isn't like.
Just wanted to make sure.
Right, no, you're right, sorry, I missed it twice. So, okay, so look what's happening here. Look at the pattern, so 11 to 21 to 31, again, forecasting, so look at what's what, but if we believe it, or say, okay, it's a trend, see, this is what more I'm talking about in terms of looking for a trend, because that gives you some more clues as opposed to believing in any particular number or a point in time. So this, what this is saying to me, even if it's totally wrong in terms of the actual percentages, there's a movement that's happening. It's going away from North America towards Asia Pacific in terms of what they're measuring here, which is essentially real estate market growth. So again, we're thinking about putting together our global portfolios. We're sitting in CalPERS in California. We're trying to figure out, I'm looking at this going, okay, that's where I think the opportunity is going to be. That starts to give us some clue. And this goes back to the other chart, which says that there's a lack of Class A commercial real estate stock in a number of these major metros in emerging Asia Pacific. So we would do the same thing back here again for, if we could, for figuring out if we, let's say we wanted to do office buildings and start to look at those comparable numbers and how they measure up. And then this too, we start to look at what is the breakdown of the available real estate in these particular markets, because each one is going to be very different. And I was really surprised. I would have thought this would have been the other way around. This was from a few years ago also, but the UK was over half retail, and France was over half office. That was interesting. At least to me, it was counterintuitive. And look at the multifamily in the UK. That's quite astonishing. I think that number's changed a lot, but, and industrial in France is only 8%. So that's where you start to see maybe there's some opportunities in those kind of more developed markets. And then, you can start to plot. Now this was interesting, I was looking at this and I was going to change it out, and I'm like, I think just about all of these are still relevant in terms of the risks. So it sort of speaks to the fact that there are certain major risk categories that will always be there, and it's just plotting changes, year to year, or 6 months or month to month, depending on whatever, but you can start to plot to see where things are on a relative basis. And to your point, is it the right time to be investing? Should we be waiting? So the CalPERS investment team is going to sit there, or the CPP or Oxford, they might sit there and act, because it's their money. They might sit there and say, maybe we should wait. Now has happened where the fund managers go out to try to raise the money for their pools and nobody wants to give money because it is the wrong timing. And people are afraid of recession and you have to also look, because a lot of the research, and even some of the research links I've given you, are produced by these managers. So even the JLL and Morgan and this one are produced by the managers. So there's a little bit of self-serving, you know? So you try to look at some of the independent ones, like some of, like this is, I think Ernst & Young. So maybe that's a little more independent, or some of the government, not-for-profit agencies that do some of this stuff, or an IPD.
What is number 6, the smooth start?
So, is the Fed going to all of a sudden quickly change interest rates, or are they going to just do it gradually? Because if they do it quickly, that could really move markets significantly. They just did another rate cut today.
Well, it's funny, one of the articles you sent us to read, it was talking about all the great things about real estate. The only downside was the expectation that interest rates were gonna start increasing, and that was a year ago, and now we're cutting them again. It's kind of funny, hard to predict.
It's right. Oh, everyone kept, for the last 10 years, everyone's been saying that they think the interest rates are going to go up. But there's, you know, the president's pushing the negative. Look at his loans, that's all I'll say. Okay, so, ta-da! First, look at the portfolio. This is how we have to start to now assemble all these bits and pieces that we've been speaking about to make it come together into a portfolio that's going to make sense. Okay? And we're going to look at, here are the different 3 markets we're going to consider because we look at size, right? So these 3 sort of made that cut. Every decision we make, we have to be able to defend. Okay? So why do we have the 3? Because they're large enough, liquid enough, and opportunity enough for us to be able to say this is where we will put our portfolio together. Then we're going to start to say which are the top tier cities we're going to choose from, and we'll look more at cities down the road, but you know, we've looked at like some of the motion indices for what's happening in different cities. So we'll start to pick certain cities based on rankings of the cities that we've seen. And we'll make some decisions based on that, right? Maybe we were looking for growth. Maybe we're looking for cities that have large university populations. You know, we'll come up with what specifically we want to decide there. Direct, how do we want to invest the capital? So we're going to do the where, then we're going to do the how. How are we going to invest the capital? Are we going to go into the REIT market? Well, what are the 3 things? Go into the REIT market, you're going to go invest directly ourselves, or we're going to maybe go into a pooled fund, right? So the first question is public-private. Then once we decide that, maybe it's both, we do baskets, you know, 25, 75, whatever. And then from that, we make decisions on the private side, how we're going to invest specifically, okay? And it's the same kind of thing. So the question then becomes, what kind of assets do we want to invest in? Now we get into the good fun part, the real estate, finally. So do we want, first, what kind of strategies? Do we want core, value add, or opportunistic? I think we've discussed those 3 categories, we're good? Yeah, okay, so that's the first thing. What kind of risk return hurdles or targets do we want? Then, do we want industrial, residential, retail, medical office, what do we want? So that's the kind of decision making. These are the kinds of groupings that we want to then ultimately create the portfolio. And it's not that you have to look at every single market around the world, but you're going to look at some indices, some charts to look at what are the things that are popping out, that sort of these themes that you're seeing out there, and what are these names, city names and countries that are standing out in terms of rankings to start to position ourselves. Because remember, you're a pension fund and you don't want to take too much risk. Okay? So this is the visualization of all the different pieces that we've been talking about. And with that. Oh. So, and then, yeah, okay, so this page, so this is like if you were standing in front of the investment committee of CalPERS or in the investment committee of any place, Blackstone, you would look to do a summary of a marketplace. And this would be essentially how we've discussed looking at the different parameters and breakdown of what the different key points are. So all of you are going to have to actually underwrite a particular country that will be assigned to you. And this is a good roadmap for you. To be thinking about, it's the macroeconomic, you start big and you go down small. So the macroeconomics we've talked about, what's happening in the markets in terms of debt in a country or in terms of their risk-free rates, is there some political explosion happening or something, so macroeconomic things that touch upon other things than just economics. The real estate market, just an overview of that marketplace and the health or challenges of that marketplace. And then the returns, what you can expect to achieve in that marketplace. And what's happening in the capital markets in terms of, is there a lot of capital going in, going out? What's happening in terms of transactions? The REIT market in that particular marketplace too. As Brenda pointed out, that's something to follow. Then you would look at that, the FTSE European one, if you were doing Europe, let's say, as a continent. So this is a nice snapshot of how you efficiently talk to a particular marketplace and capture all the critical pieces, because there's a lot to cover. If you can do it succinctly in a way that tells a really good story to convince, because that's ultimately what you're going to do. You're going to have to convince us to give you money. Like the rest of us are going to listen to you guys, and we're going to be the investment committee, and you're standing up and you want money from us. So that this is what you have to do to convince us. And we're going to challenge you. We push back. So, be prepared. All right, so how are we doing? What time is it? Oh my goodness. Okay, let's take a little break. I need some water. But we've covered a lot, I think, right? And there's a lot more to go. I'm going to, you know what, when we come back, let's come back at 8. Let's do the lesson.
Assignment.
Thank you. The assignment. So I want to start making you think and look at that. So I want you then to take next week to think about questions, and we'll come back and talk about it some more, but I want to make sure we cover that. Okay? That was the first time we were serenaded during class.
这个就是差的，我也不知道。充电器比较大。不是这个，我之前都装进去，后来又充不进去。我应该是外卖的那种电脑的这个，不是我得上课前充进去。我操！
How's that deal going that you're working on?
We signed papers, a week ago.
Oh, nice.
So that's just for the purchase and sale agreement.
Okay.
So now I'm in due diligence.
Sure.
So that's I just finished hiring all the different contractors and environmental people and stuff. So
Very cool.
thanks. But I almost had a heart attack this afternoon.
Why is that?
So they set up. You've heard of like the electronic deal rooms, the data rooms. So I'm used to seeing an electronic data room. Someone sends you a notice and invitation, and you fill out a form and whatever. This group sent me and sent to some of my contractors. They used, some administrative person there used the cover that was the first marketing piece that they used. So saying brand new property on the market. So all I saw was the cover of like the announcement of the marketing this building that we're trying to buy.
Mm-hmm.
And I'm like, and some people are sending, and I'm getting like 3 or 4 of them, like contractors, I'm sending it out to all my contractors, and it's like, it looks like they're trying to sell a building, like they're not, what's going on? And I'm like, oh my God, what is this? So I finally got one of the guys, and I said, and he was like laughing, and he's like, it was the cover that they used for the invitation to the electronic data room, was the marketing piece announcing that the property was for sale. I was like, why did you do that? Like, I'm sitting there, I was literally like, it's pretty.
Well, what would be their reason? Was it a mistake? Or?
You know what it was? I'll tell you what it was. It was an administrative person who works on the team who just wanted to make it look nice.
Okay.
So they had a really great photo of the building, they had a nice banner, they had the address. She just changed the name of who to contact, who I'm working with now, and I'm like, why are they putting his, but it was scary to see the announcement of they're marketing the building,
Yeah.
and like everyone's getting this, and I'm like, what? So, because the way due diligence works here is, if anyone's gone through this, maybe you have, Brenda, I'm sure you have. Within this window, usually it's 60, 90 days, either party can typically
Back out.
exit, stage left.
Mm-hmm.
So I'm like,
Even the seller can?
both can. And I'm working, at some point when it's done, I'll tell you who it is, but I'm working with a very large institution. And one of the reasons I'm doing with a large institution is because when you're dealing with individuals, it's too much vagary. Like people do things because, I don't know, the brother-in-law said something, you know. Whereas the institution, it's much more, we're doing this. And then they have to change, like it's a major thing to change something. So to me, that's much more certainty. But but they've been very back and forth, so I'm like, ooh.
Is the seller's ability to walk away during due diligence, is that like across the US or is that just in like the craziest markets?
No, it's
Right in
typical.
the West, they do it all the time.
Yeah.
Just-
They just, now, what you'll do is you'll have sort of something in there that if somebody defaults for some reason, then you get paid your expenses typically, or something. But because it's not a long period of time. It's only like it's like 2 months typically, 16, maybe 3 months.
Yeah. I mean, I worked as a broker for 5 years before I moved down here, just in
Oh,
Canada.
right, you told me, right.
Like the seller has, like you can get sued and forced to perform the contract if they decide to waive their conditions. Like it's all on the buyer, and once you've signed that deal, like if they don't waive their condition, then you're out of it. But if they decide they want to go forward and you've got another offer waiting, too bad,
Right.
you signed a deal.
But and that was in commercial, that wasn't just.
That was in commercial. I was
Right.
like selling like their
Office
big
buildings and-
big deals.
Right.
It's different.
You know, everyone's going to negotiate whatever. They're here, I'm here.
Yeah.
That's a piece of it too.
I missed the first part of the story. I was just kind of
this is
speaking
the
more in
building
general.
we're trying to buy a building.
Okay.
And so I said we signed the purchase and sale agreement, and so we're in due diligence now. But I'm saying, you know, so all of a sudden they sent out like at 4 o'clock this afternoon, we get this copy of what was the cover for the marketing piece for the building originally. What I didn't know is that was some administrative person wanted to make it look nice. She used that for the cover for the electronic data room. But all I saw was the cover, and several people got it and sent it to me, and I'm like, what is going on? So I freaked out a little bit.
Fair
Not a
enough.
little, a lot.
A lot.
So, but yeah, thanks for asking.
Yeah.
Yeah.
Does it take a while to get to that level where you can start working with institutional investors?
It was a very highly competitive bid situation,
Okay.
and I went above and beyond. What I did was, just learning. I got people from the industries from very senior levels give me letters to say that I'd be a great purchaser. So I did a lot of things that you wouldn't normally do
Right.
to convince them that, because this is the first thing for my company. So, you know, and I have a resume, so I was able to use that, and people in the industry know me.
Sure.
So that helped. So I put together a story. You always have to build a story, build credibility. So that helped a lot.
Was it an RFP process?
It was a competitive bid situation. It wasn't a formal RFP, but I put together a whole package of information. So that helped as well.
Yeah.
And the other thing that I did was I went to broker's office, because it was through a broker. The company hired a broker. And I went to them to befriend them. So they helped me. Because they control so much of this. There was someone who I used to work for where I was also asking for guidance during this process. And he said, go take them to lunch.
Makes such a big difference if you're siding between two people who are relatively similar and you know one of them and you don't know the other one.
Right.
Like you obviously can't give away super private or confidential information, but if it comes down to recommending somebody you don't know versus someone you've met 5 times, or you might have done a deal with in the past, or you've been out to lunch and had a chance to meet it.
Right, you get to know them personally.
Yeah.
And you see who they are. And, yeah. But also the brokers will give you pricing guidance as well. So, yeah, so I use them a lot.
It's not always right.
No, it's not. It's not. But I have to say though, the broker is motivated the same way the seller is motivated. They want to get the deal done.
Mm-hmm.
So it makes sense for the broker to choose who they think can close the deal.
Absolutely.
So
Yeah, I mean, you have to work on those relationships. so
exactly,
much.
they're
Yes.
critical.
Yeah,
Critical. And people underestimate
yeah.
the value of the brokerage community, and I think it's really
We
not.
work with some brokers in New Jersey, and they're very local,
Mm-hmm.
and all of the properties that we've gotten,
Are local.
they've been with this broker.
Right,
And then
yeah.
we try to build a relationship with CBRE, for example, they're much bigger, and this guy already has his relationships built, and yeah, you're trying to get in there, but he's like toast. You know, like you try to, and when you get a deal from him, you can't get any information because he already has his own relationships and his people that he knows they're gonna close. So it's very hard. I mean, you have to really work on those relationships.
But you can start to build it.
Yeah, exactly. But it takes time.
Takes time, right, exactly. Takes time. So, okay, so enough about my deal. I'll keep you posted. It's taking a long time. Let me just do the what's it called, attendance. So, let's see, Alejandro, okay, and Brenda, there, Anmal, there, and David, we lost David, okay. Austin, and Nate, and Hush, and Lily. Am I saying it right? Lily? No? Okay. Jared, you're hanging out, okay. And you, Zane? Yeah. And Shifeng? And Jessica's stay work. Okay, good. Alright, so. Alright, so GIC is one of the largest pension funds in the world. They are from Singapore. And it's the sovereign wealth fund for Singapore. Did I not get you?
No, I think it might be because I signed up, I think 2 days after the semester started.
Wait,
So maybe,
Victor,
yeah.
sorry.
You got me.
I was like, look, I didn't call your name. Okay, so GIC, one of the largest pension funds in the world. It's very similar to like the ones in Canada that have done their own investing programs. And so these guys I mentioned before I knew wrote an article, the one I sent the other day to you guys, that essentially speaks to how do you figure out what kind of returns you need to invest outside of your marketplace. Again, I highly suggest you read the article. It's very well written, it's simple, it's way better than I can explain, but, and will sink in. So this is what we've been speaking about, okay? So this is US real estate baseline, which we start with. So we start with the US Treasuries, right? Oh, I wanted to speak about that. So right now, the US Treasury is, I don't know, what is it now, 2 something, 1 something?
It's just under 2.
Okay, so it's somewhat of an anomaly. So even though I'm saying now to start with the US, the risk-free rate that we've been discussing, right? We might rethink that just because we're in such a strange moment in time with this. Just keep that in mind. Nothing to do anything, and if you just use the risk-free rate and everything we're doing, it's fine. But I think you should just be aware that maybe this moment in time needs some change, consideration of that. Okay?
They identified that in the article like 10 years ago.
Oh, they did?
Yeah, they said that right now it's lower, but historically it's been higher. We're going to use 2.5 even though it's
There you go.
lower.
Right, see, smart. So, all right, so we start with that. We all said, we all understand why, right? Risk-free rate, simple, easy, no, it's the safest rate, okay. Then we're going to add on the real estate hurdle, okay? So remember we discussed that if you're investing in real estate, it's illiquid, okay? And we want to look at what is it that we need how much do we need as a cushion to invest into real estate? For what? It takes, so what I just told you, it's some suffering, right? It takes a long time, it's costly. My friend said to me the other day, every real estate deal takes longer and costs more than you think. So it takes long to get in, get out, all of those things, the illiquidity of investing into real estate, you need to get paid for. So, and we're looking at the baseline of the simplest, easiest, safest thing is the US Treasury rate. How much more do we need of a cushion to invest into real estate? Okay? That's really what that is.
Should we identify factors as well? What
Say
factors? What factors are the ones that?
Okay.
That's the next
Hold
one?
that question.
Okay, yeah.
Right?
I remember reading it. Yeah.
Okay, no, that's good. You're thinking ahead. Perfect. Okay. Then we're going to look at the foreign investment risk. Okay? So this is the country's sovereign credit, which is what? The country's
Treasury.
exactly. Country's treasury rate. So we're looking country to country now. So now we're going to look at the foreign country's treasury rates.
Is that their rate or the difference between their rate and the US rate? Like if their rate was the same as the US rate, or is it like with, say it says they're 2 to 2.5%, does that mean their rate is 4.5 to 5?
Well, you're going to have to, no, that should be the actual rate. Because you're going to have to ultimately subtract everything.
Okay.
And I'll show you in a minute, but yeah, it's a good question. So yeah, so that's like their rate is like 2, 2.5.
Okay.
And then, now, to Russia's questions, what are the different risks? Okay? So we're looking at, and this is what they came up with. You'll come up with your own, or maybe you just copy theirs, whatever. But it's property and contract rights, right? So how easy is it to get an actual contract and to get people to abide by it? You can sign anything you want, but it's not enforceable in a country. What's it worth, right? So you need to know that there's a legal administration support for what you're doing. Lack of transparency. We spoke about if you can't get the data. You have no idea what the real vacancy rate is. You have no idea what the average rental rate is, right? That's going to be really difficult, makes life hard. Lack of liquidity, we've discussed it a lot. Joint ownership, maybe you want to have, what do you want in going to a foreign country, going to Vietnam? What do you want to invest in Vietnam? What do you think you need? What is the most important thing that you need to invest in?
Local partner.
Exactly.
Many of the countries require
That's
foreign,
right.
a foreign firm to collab with like
Exactly.
India for that matter.
Right.
To
So
allow-
you need to have a foreign partner because you can't just fly in and think you know everything and be the rock star. It's just not gonna happen. You'll fall, collapse, not gonna work. Okay, so how hard is it to get that partner? How much you're going to have to pay them? How much you're gonna, how are you gonna find someone to even trust? Right, so all that's difficult, and then other real estate risks, whatever. So, then you come up with your real estate subtotal of risks, your basket of risks, and what you think your range is for those risks. Then you have currency, which we will talk about, so currency risks, inflation, and then market inflation for that particular marketplace, and then taxes. So what they do is they start with their treasury rates, right? They add a premium. So the 2.5% they added, it's usually, I think even that article talks like 2%, about 2%, 200 basis point cushion, add on, that everybody wants just because it's real estate and just because it's illiquid, just generally. But you can, we've looked at some things, you go back to some of the slides we looked at from the first and second sessions, we've looked at what the average, and it was less than 2. I don't remember the exact number, but it's like 6 or 7 or something, of what exactly it is these days, in terms of what people are looking for investing in real estate compared to other asset classes. Don't go crazy with that, pick a number, don't, you know. So, they put their number in, Then they add this basket of risks, currency, transparency, all of that stuff with a range. And don't worry about the taxes at this point, but taxes obviously come into play in your world. And they say, okay, that's what I need to invest in these countries. Now, the question is going to be, is it available? As opposed to sitting in your desk and somebody hands you a flyer for, something, again, in Sao Paulo, for this great deal, right? And we're all like, oh, we have the deal. Versus having a plan, having a strategy, saying what makes sense? How do I go about doing this? Can I get, if I need a 20% return to go into Brazil, being an educated investor and making the decisions based on that, as opposed to just being responsive to what flies into your inbox. Okay, so does this all make sense? Like, tell me if it doesn't, please. Does this make sense? Is this resonating for everybody? I'm looking at all the faces to see if I can figure out.
Which section of that was that premium we talked about?
The top.
Okay, I see. So that's added at the beginning?
Yes, because it is the top of the heap in terms of, am I going to bonds? Or am I going to real estate? Right? This is all very logical. Alright, now move on. And you have this, you have this. So. But we can go back to this. But I want to look at okay. So this is the assignment. Okay. So what this is how we're determining what the risk premium looks like by these countries. So, okay, so these are the countries we're looking at. We have the U.S. to start with. So remember, and again, we are U.S. investors from CalPERS. Okay? So we're going to look at a basket to invest into the U.K., France, Japan, Brazil, China, I shouldn't say Hong Kong, well, China, Hong Kong, whatever, China, and India. Okay? So that's our global possible marketplace of where to invest. Alright? First thing we're going to do is we're looking at we're just getting our sense of these markets. So we want to look at some just major key indicators. I think I put in the right numbers for the US. The rest are all old numbers, so don't look at my numbers there. And you'll adjust because I did this like whenever it was, last weekend, I think I did this. So I looked at the S&P, I looked at the 52-week change, I looked at inflation. Oh, that says it shouldn't say 2010, 2011, it should say 2018 and 19, I think I did. So now I'm going to put the right chart in there. Well, it's the right format, and you'll see what you have to do.
The one you posted has more newer numbers.
Oh, so I don't know why I did that. Okay, I didn't put it in here. That's weird. Okay. All right, so those are the right numbers now. So you have the right numbers, but you'll adjust it because it will be like a week or two later or something. So what does this do? This gives us a picture of what's happening in the stock markets, what's happening in treasuries, what's happening in inflation. So we're getting a good view comparatively for these different countries, okay? Don't forget to fill this chart in. The 10-year, for some reason, a lot of students forget to do this. The 10-year government bond spreads. The latest spread versus T-bond. This is from from the U.S. perspective compared to that particular country. Okay, so we're doing a few other countries on the side to just take a look and see how things sort of span out.
Professor?
Yes.
What does a major index number tell you?
what is a major, oh, so the major, like the S&P 500,
Mhm.
so that's a major stock market index. So each country has like a major, and I tell you which of the indices are.
No, but I see that, but like what will the 1141 tell you? Like what does that mean?
Well, you're looking at also the 52-week change, right?
Yes.
So you're looking at what's happening in the equities market to just give a snapshot. I mean, we don't want to get too carried away with it,
Mhm.
but you're giving a little bit of a snapshot of looking at what's happened in the last year.
Okay.
Okay? If you can think of other things we can add or change, whatever, but that's sort of how I sort of narrowed things down to keep it simple. Did it go up? Did it go down? Was there a big shift? A little shift? You know, where are we? And
Is it a price? The index number?
no, the index shows you, like the S&P 500 are Fortune 500 companies and what they're trading at, and the index shows you the movement of those stocks for any point in time.
Okay.
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 So, yeah. So this is just showing you what's happening in the stock market generally for equities over the last 52 weeks, and that's what's used is these index for these particular countries. That I picked the largest indices for each of these countries that you'll get familiar with. Okay. Like the most trading is done in these indices for that country. So you'll see the most activity there. Okay, so sovereign risk, this is very important, can be determined by comparing the difference between the countries' plural treasury bonds. 10-year bond is the common benchmark we've been discussing. Okay. So now the next page is doing what that article spoke about. Okay? So we start with the US Treasury real rate, this is wrong, but the other one I did hopefully is right. The US real estate hurdle is what we think we need as additional return to invest into real estate. That's what that means. Okay, so remember we said mostly it's around 2% or so. Okay? This you need to look up, and again, I think I did it right on, this is an old one, so apologies that I have, well, I don't know how I did that, but whatever. The US real estate hurdle from core. So how are we going to get that?
These are the cap rates of the. Can it be Night Creek?
Exactly. So it's not a cap rate, it's a total return. Okay? So cap rate just shows you an income, right? We want to look at the total return, which is income and appreciation. So the NCREIF, NCREIF index, right, that we looked at, does core real estate without debt. And you'll go onto their website and you will find, actually I did it, it's whatever I sent out has the right number, but you can look at it. You should get used to it, just go look at it again.
So for this number you put in here, this, for example, in the updated one, the US Treasury road rate is 2.39%, which is like a half point above, so you just adjusted it based on what we talked about earlier, where like they're historically low, or you think this is an
No,
old
that's
number?
what, when I looked at it, that's what it was that day,
Oh, okay.
I think, unless I looked
I'm
something wrong.
wondering whether it's an old number or not, because I don't think it's been above 2% for a while, so my question was like,
I was surprised how high it was when I looked, but
for this, should we use the actual,
use the actual.
rate?
Yes, yeah. Forget my numbers. I don't know what
Check them all.
thought I did the right thing, and I'm not sure what I posted where, so now I'm a little confused with what I did. Apologize. So, but I want you to understand what the things are. Okay, so we're going to look at the NCREIF core real estate US number. And so these numbers go across, because that's what we're judging everything against, because we are US investors for this assignment. Okay, then this is where you guys come in. Now you're going to start filling all this out, okay? And you're going to look at these different risks that we spoke about, and you're going to choose which risks you think are the most critical ones, and assign percentage to each of the different countries.
And reason then.
Okay, so this is the homework, okay? So you remember, we're getting 4 assignments this term. This is the first one. This is what you're going to get graded on, obviously. I'm going to want you to defend. I don't want to just look at a bunch of numbers. I want to see that why you chose what you chose. Now, you can choose to, don't go crazy, don't give me like 20 pages of slides, but you can choose to give me some data, you can copy and paste from the web, certain information that you took, and then you can do like a summary page. These are the 3 bullet points, why I chose these numbers, or whatever you want to do. So you can back it up if you want. If you want to just hand it in, that's fine. We are going to get together. I have to figure out, because there's more of you than normal here, so I have to figure out, I usually have everyone defend their individual, but maybe we'll do it a little differently. So we'll figure that out. But you will need to make sure you understand why it is you chose the numbers you chose. Okay? And you can share that with me any which way you want. In terms of writing or not writing, whatever.
Question on the foreign investment risk. So I get reports from our insurance department, and it goes over like the political climate.
Great.
But I mean, I don't know how reliable that is, or
Well,
what
you have to
those
source.
weight
So you
is
have,
for
okay,
that.
it's a good question. So you have to source. Show me the sources of what you use. I try to put source materials on everything I show you. So show me the sources, and what you might do if you're feeling uncomfortable with it, go look at another 1 or 2 sources to see, does that make sense? But if it's a reliable, big insurance company, whatever it is, you feel like, okay, yeah, that makes sense, then it's okay. Because I don't want you to question it, I mean, when you're in the real world, yes, you should question everything. But here, let's not get too carried away, just do the work and don't worry so much about that. That's good.
And then in terms of the numbers themselves, going back to the example you had sent us that was in that reading, most of them, with the exception of other real estate risks, are between 0 and 1%. Obviously, we can kind of justify what the background for an additional risk is, but in terms of the actual number, it's generally probably going to be somewhere in that range, unless there's a significant reason to make it significantly more than 1% or 2% or whatever it is. I mean, that's kind of
Yes.
subjective to an certain extent.
Yeah, there's
Almost
more
entirely.
art than science,
Okay.
definitely. And the question is, if you make it 5-10%, you'll never get to be able to invest.
Yep.
So you have to be somewhat, you want to be considerate, but don't go.
Yeah, so I have some general reasoning, but it's not going to be for the exact numbers.
Right. No one's
really.
going right.
Yeah,
I'm not
gotcha.
looking right. It's just you move thoughtful.
Perfect.
That's all.
I will
And
best
you looked at the country, and part of it is these countries have very different profiles. So that's a piece of the why I chose what I chose. Like a Brazil, now especially, compared to France, let's say.
No, I was saying use our best judgment
Yes.
on the risks.
Right, and then you can back it up.
Back it up with some.
The GDP growth, it's all the things we've been talking about, right? This is the culmination of all these different concepts we've been talking about. This has been looking at the indices, now we're looking at the GDP, all these different metrics. This is how do you use the metrics now and apply it into the real estate world of making decisions. Okay? Okay, so here's the time. All right, so clear? Any questions during the week? Contact me, I'm available. And we'll go over it next week. So just next week, bring questions. Oh, it's gonna be fun to show you. I'll show you now. Do you understand how leverage works? Alright, take a look at this. This is totally off the beam track, but I want it's just good. I like this. It just teaches you something. is this saying? We're doing a deal, right? Doing a deal for $100 million, or $100, right? $100 million. And we want to make some decisions based on debt versus equity. So what's the first thing we're going to look at, making that decision?
The cost of debt.
Mm-hmm. And what are we going to compare that to? Exactly. What are we going to compare that to?
Cost
Cash.
of equity.
Yes, the return on the equity.
Cash on.
What do we want? We want to create positive leverage. So how do you create positive leverage?
Debt less than the cost of debt is less than the
Cost of.
Return
Of the
on
equity, of the
investment,
return.
Yeah.
Exactly. So we never want negative leverage
Yeah.
because it doesn't do anything for us. It takes away from us. We want to make sure that the equity return is greater than the debt, the cost of debt. So that's the first hurdle. So let's say we say, okay, we think it is. I'm going to get like a 7% return, and cost of debt now is somewhere around 4.5, let's say. So I'm like, okay, I have room to move. I can leverage my equity, take some of my equity out of the project, and get a return on. And what is the leverage doing to? What is the debt actually doing to the equity?
It's decreasing your equity amount.
It's decreasing.
Yeah.
Decreasing the amount of equity needed.
Yeah,
Yes.
That's in the project. So
Right, but
that's
what is
your
it
returns,
doing
yeah,
to the nature of the equity?
Increasing the purchasing power.
Yes. You see, I'm so like wanting something else. Okay.
What's increasing that percentage of return that's associated with your equity, like debt arbitrage between the debt and the.
Yes, it's increasing your return on the equity. So this is how this works. So what we're saying is, first question is it positive leverage? We said yes, okay? Now, the question is going to be, how do we make sure that the debt, the leverage, increases the equity by a good enough amount to make it worth our while to do this? You all following me? No is okay. All right. So you won't get one with this. All right, fine. Okay, so let's look at the example. $100 million. The net cash flow, let's say it was 10%. That's just a plug number, okay? 10% net cash flow before this was $10. The debt service, so the interest was 8%. Okay? So the equity was 10, debt is 8, times the debt. So 8% times the amount of the debt taken out is $5.33. So the net cash flow after debt service is $4.67. Okay? So to get to the returns, the return on equity is the 467 divided by the how much equity we put in. You all there? 33, 36. So it's 14%. Versus if we just did the property return of the $10 per hundred, it's 10%. So what did the leverage do?
Boosted your returns.
400 basis points. That's pretty nice.
Yeah. Very nice.
And so you're walking away with, instead of getting the $10, you're getting $4.67 in your cash flow, but you're getting your equity back to then go to your next deal, right? And you're boosting your return on your equity by 400 basis points, by 4%.
Where's the 8% coming from?
The 8% is the debt, is the amount of the interest on the debt,
Interesting.
right?
I was just looking at the one that was posted online. I noticed on the assignment you had on the screen there was different interest rates and debt percentages for each country.
Back to the home.
Back to the assignment.
Yeah.
It was
okay.
written on the page, but on the one posted online that's not. There's no information.
Wait, tell me.
Like
On this?
on the go to the next slide. To the
Yeah.
top it says assume the available estimate. Sorry, I can't speak. Available investment is office was 66% debt. Like there's different instructions for every country.
Yes.
That's not on the one that's posted online.
Oh, it
that-
should be.
So my point was to
Oh,
just
I'll
maybe
do
read,
that, I'll do that.
just letting you know.
Yeah, thank you. So that, what the top
That little
banner was-
blue banner is gone.
Really? Oh, that's weird. Okay, I will make sure that's posted.
Perfect.
Okay. So that's why this is important for this, what we just did. Okay, so we all get, thank you. So we all get that?
And how do you find the maximization of how much to take on to maximize?
Next page.
Oh.
Okay, so that's the decision, right? Now, part of the decision is made for you because banks will only lend up to 75, I mean, you have to be your best friend or your brother-in-law, whatever, 80%, whatever, but typically 75%. So usually it's in a range between 50 to 75%, give or take. So here is, the question is how much debt and how much equity, and the debt is staying constant at the 8%, and your total leverage return moves up. But remember something, what are you giving up? The more more leverage you put on, you're giving up cash flow. So you might want that cash flow. So part of the decision is going to be made by you in thinking about how much cash flow do I really want? And how much am I willing to give up? And am I going to do I need my equity out to go buy the next property? And then you're going to look at, well, how much is the equity, what is that disparity between the debt and the equity, and how much more return is it buying me? So in this instance, everything stays at 8% interest, right? But we have 50, 60, and 75% debt, and the return is going up 200 basis points per extra 10% and then 15%. So 10 to 15% is buying you an extra 200 basis points in return on equity. But remember something, a large portion of my career was spent restructuring loans, failed loans, because people take out too much debt. So you have to think about also, you could lose the property. Because if you know that there's a lot of leases coming due at a certain point in time, or concerned that there's a recession coming, or whatever it is, you need to be thinking through, you don't want to lose the property. Yes.
Say I owned a property, right, and I thought that there was gonna be a downturn, so I just stopped paying the debt service on my loans so that it would get restructured.
You don't get restructured?
No, so that it would get restructured so I could have a lower rate.
Oh.
Is
Well,
that
you
like,
think that it will happen that way?
I don't know.
Risky.
Like,
Oh, true new developer. So, it depends,
yeah,
okay? There was a saying that used to be, pretend and extend.
yeah,
Because the banks, you're partially right, because the banks don't want to have to write off
yeah,
a loan. It's a failure.
yeah,
They would rather write down. So it's not as big of a failure.
yeah.
So they write down, and then we'll renegotiate with you,
Yeah.
which I did a lot of,
Yeah.
to say, okay, it was X, now we'll make it Y,
Okay.
instead of this rate,
Yeah.
you know.
Yeah.
But it could also be that you'll end up giving up equity,
Yeah.
right?
Yeah.
Because, or I can say, well, I'm going to take a piece at the end
Yeah.
when you sell it.
Mm.
So there's gonna be a cost for you to do that.
Yeah.
Not,
Yeah.
you know,
Doesn't come
that
free,
goes
yeah.
on that done. So,
Their sole job is to make money.
but you see, this is how you make that decision. By looking at how much more return are you getting on your equity, the additional leverage, and how much risk are you taking to put that additional leverage on? Is it worth it? And how, also, remember something, you have to think about, there's going to be unknown capital improvements needed to be done, right? So you need to leave yourself reserves and all sorts of things so that you can pay it from the cash flow. So you don't have to start taking it out of your pocket.
And for example, CalPERS, do they have a limit in?
Yes, good question. So a lot of these pension funds used to not do any debt. I worked for a company which is now part of Deutsche Bank, it's called Reef, and we did no debt. It was just like none. I think that's silly, but so the likes of the institutions, the pension funds, they didn't really like to do debt. So at first, they only did core kind of real estate, which typically has 0 to 50% debt. And so they were doing like, we'll do 20, 25%, but low amounts. Now you'll see, and especially, so what's happened is the global world, going overseas for these guys, the managers say, oh, we're gonna get these huge 20, when I first went to Asia, we were doing 20% plus net returns to the investors. So how did we do that? We did that by going to emerging markets or developing markets that hadn't been tapped into, but also by using debt. Now the interesting thing is, one of my partners was saying to me, can't we get this property I'm looking at, can't we not go to a Japanese bank and get some Japanese debt? Because the interest rates there are negative. No, they only do debt in their fund, they're not like going to transport it here, for different rates. So the point is, you can look at a country like Japan and go there and you think the sky's the limit in terms of how much debt because it's so cheap, but you still have to be careful because the returns aren't as high, so it also evens itself out. But this is a really good tool, just in anything you do, and then also for the homework. So, I'm not going to go through all this, don't worry. I'm going to just back to where we started. Okay. Alright, so here's a nice summary chart for you guys on the different indices. Okay, so really easy tool for you to take a look at. We didn't discuss Preqin. I didn't even know they were doing it. Preqin is, you should know Preqin. Preqin follows and gives very good reports on the investors, the fund markets, and funds. So they follow all of this more. That's like the go-to for most of these institutions. We'll look at if it's like a CalPERS looking for a fund, or if it's a manager looking what the investors are saying or what the competitors are doing. They will look at a Preqin report. They all subscribe to these major reports on. Townsend is a well, it's changed that they were bought, but it's one of the largest consulting firms. That's another constituent in this whole industry, are these consultants that advise the pension funds. Let's look at IPD. And you can look at this at your leisure. Okay, so this compares nicely, I think, what's happened with GDP growth in the country versus the REIT market, so the NAREIT is monitoring that, versus the NACREIF, and how the three move somewhat in sync, but you can see how less volatile the private NACREIF, the red line, is compared to the volatility of the REIT marketplace. So that's like a nice snapshot to explain why you invest privately versus necessarily everything into the REIT marketplace. And this was looking globally, quarter to quarter, for a nice period of time. Because part of the question is going to be, as a U.S. investor, should I even bother? Am I going to get paid to go overseas? And should I bother? So the question then, the next question is, well, how has it behaved? How is it done? Has it outperformed the North American or U.S. marketplace? You look at this, No? So, look at the global red line compared to the blue line in North America. Now, this is an old chart from 2012, but it's pretty much in sync. So again, it's not necessarily the right answer for a US investor potentially. You still want the diversification. That was the first thing we discussed when we all met, because that's why you're doing it. Volatility. So this brings together what we spoke about the other week about Sharpe ratio and the standard deviation and looking at that. So global versus North America and I guess that's Europe. Quite a distinction in terms of the growth opportunity. But how much are you looking at in terms of volatility, which is pretty significant at 18% for global. So you have 20% return, but 18% volatility. So remember, we can't forget our Sharpe ratio and our standard deviations in looking at these returns and things. And this is how the US compares to other markets. And again, everything's moving in sync. And I think that's really what's happened globally in many instances where there's a synchronization because there's a lack of distinction in diversity, if that makes sense. The diversity isn't as great as it used to be. Maybe that's an easier way of saying it. And because of that, things have come more together. So it's all moving in tandem. There's a difference, and you might just do it just for the sake of having that diversification, but set the stage so that everyone's expectations are met, that it's not that you're going to have this outsized performance necessarily. Okay? So there's lots of reasons why you would do something like a global program. So this you could use actually for your homework. So this is looking at the difference in property yields versus government bonds. And then versus the top charts versus BBB rated, so it's corporate bonds. So that could be municipal bonds too. So look at the property yields, like in Europe. Pretty good. Because remember we said that real estate was equivalent to, I forgot what the rating was, but it was like maybe a BB typical corporate bond. So this looks pretty healthy. And the same thing in Asia as well. So again, all the backup or support of why you would do real estate and what you can expect in it from these other asset classes. And then looking at the city's yields on a comparative basis, I like that. So this is 15-year average yield spread over 10-year bonds for real estate for global city yields. So, okay, so the triangles, the golden triangles are the 15-year average spread. So that's the actual difference between the two. And then the blue is current yields, the current spread over a 10-year bond for the fourth quarter of last year. So what does that say? What are we looking at there? If you're just looking at just that bottom chart, where would you look to potentially invest, just based on that information?
Beijing.
Mm-hmm. Right? Does everyone see that? You're looking for the disparity. You're looking for the opportunity for growth. think Shanghai maybe. Osaka maybe even?
What I don't understand is how do you get your cash out of China though?
It's a good question. So, and actually, I left an article, there's an article today or yesterday in the Financial Times talking about China allowing more foreign investment. So they have to be very smart about things. And if they are not going to allow capital to leave, capital's not gonna come in. And they do want foreign capital to come in. So there was initially, I'd say 10, 15 years ago, there were some problems, but it seems to have been much more quiet on those terms.
Because part of the problem we have with the brokerage firm is that it takes 2 years to get the cash out of China. So
Well, I
I'm just
don't-
kind of
so
wondering how other people do
They're
it.
selling real estate, or what are they doing?
No, like when they get a commission off of our deals,
Oh.
it takes 2 years before that cash will come over into the US.
That could be somewhat of a corporate issue,
Oh, I see.
you know? Because I know if you sell a property, you can get your money.
I know a lot more of the issues is bringing local capital out of China now. Like if you're
Yes.
a Chinese citizen trying to bring capital to the US, it's a lot tougher, but I think with
Right.
foreigners, it's kind of a different set of rules because they're trying to encourage you to come, whereas the
Right,
locals
they
are
want,
trying to encourage you
that's
to
called
stay.
FDI, foreign direct investment, and they want that. So, right, and they stopped, so some of the largest, the US real estate market will feel it, because there's been a lot of pullback. Penang, what's her name? King Kong, I think, who bought the Waldorf and renovating that, like they've stopped everything now in terms of doing any more investing here, from what I understand.
We saw it in Canada too, there was like tons of foreign investment and it was like every single deal they were coming in paying crazy prices and it seemed like in a number of months it just completely disappeared.
Right. Yeah. So, but it's a concern. It's a concern, but and it could change. That's why you need more return to go to a place like that, because of exactly that point. It can change, and it can change pretty quickly. So, but yeah, so you can start to see the different comparisons. And this is more of the same, of the cap rate spreads over 10-year government bonds, and this is over a long-term average. Oh, and this was interesting, this is, hold on, boy, I didn't do a good job this week, sorry guys, sorry. So these are gains and losses over a 1, 3, 5, and 7-year period, listed versus unlisted real estate. And you can see that the losses for unlisted are less in every category of time, which again bodes well, which is interesting. So it speaks more to the volatility again, as opposed to the actual underlying real estate necessarily. And then the actual returns, based on, we speak about return, obviously we talk about income and appreciation versus total. And the appreciation return has been going down somewhat. A little bit worrisome. But everything I don't know about you guys, but everything I'm reading and listening to and speaking to people are pretty still confident in terms of where we are in the real estate market. They're not expecting the kind of growth that we've had, but they are saying we're pretty okay for the moment. And the investors still and look, as I said, Blackstone raised a $20 billion fund, for goodness sake. So the investors are voting for the market with their pocketbooks. So that's a good sign for all of us. So that's an interesting point. That's unusual for capital returns to be less than income without it going negative. So normally it would indicate a real downturn in the marketplace, and it hasn't. It's just sort of stabilized itself out a bit. up there. This I just got from the increase the other day, so this is current. But it's interesting that it's, other than, so it started really in 2015-ish, to start to take off compared to the other asset sectors. And you look at retail. But you know, it's really difficult because retail, if you look at the numbers behind this, it's mostly these very large malls.
Anchor tenant.
Right.
Going bankrupt.
Right. So there's a lot of retail that's doing fine.
Yep.
So you have to really, again, slice and dice. But compared to the index, it's looking pretty sorry. And we were talking about apartments before, and apartments also have been falling below the index. There's been a lot of capital moving into that. And this is what we were talking about before versus core, and this looks at, so this is the global real estate securities, which is publicly traded, that sell, puts that together, versus core private returns. And again, here you just see the extreme movement of the public markets. So this is a summary of just again, what are the different pieces of the puzzle that everyone looks for in terms of the economic and again, you can use this as part of your analysis of putting your portfolio together. This is pretty much the same as what's on there. Oh, we didn't talk about lease structures. The kinds of whether it's a triple net lease or in different countries, there are different kinds of lease structures that are used. So it does make a big difference in terms of where you are in the world. Some lease structures were used as essentially the debt. I might have mentioned, I don't know, in Korea, the lease, it used to be, it's changed now, but not too long ago, it was that you had to pay the entire lease as a tenant, you had to pay the entire lease up front. Because there was no debt. And what the developers did was so they would take that rental money and use that in place of debt and then use that to then go buy the next property. So versus other places in the world where that's unheard of.
I don't have that problem so much in Korea. I have it a lot in India and China.
Oh, really?
Yeah.
Doesn't that effectively take the little guy out of the market? Like if you're a small business, how could you ever possibly, for the most part, have, like if you're a huge company, it's a pain, but you can afford to do it. If you're a small business, like you're SOL.
Well, and part of it is because there's, and you look at places like Korea, how it used to be, and you're saying now India, but also Brazil, debt is a relatively new, more industrialized concept, and without it, it's the little guy can't really compete.
Can't get ahead at that point.
Right, unless they start to raise capital from the equities, from people. But without the debt market, so that's something that you do look at and going into these markets. How viable is a debt market in these different countries, in these different markets? Because that really has an impact on what you do in terms of being able to buy real estate and stuff.
How does the bank guarantees work?
The bank guarantees?
Yeah, because I have leases where we have to buy a bank guarantee for the total contract value.
Right, so I, as a landlord, say, if you are a weak credit tenant, I might be concerned to rent you the space. So I will ask you to give me some kind of security, either pay me more rent up front, or give me a guarantee that I will get paid, so that if you default, I can then pull on the bank guarantee. So the tenant has an arrangement with the lender, with the bank, that puts aside a certain amount of capital that that the landlord needs, that they can just pull from there.
Okay.
I think we're out of time. All right, so take a look at the homework again, come back with questions, or you can email me, whatever, and we will continue onward.
Thank you.
Thank you.
Professor. Sorry? 8:50.